Okay, folks, we'll be starting in 1 second. It's great to be with everyone. All right, it's 4:30 Eastern. Welcome to the Art of TradeStation. I am David Russell. It's great to be with everyone. I'm VP of Market Intelligence here at TradeStation Group. Let me first just read you some quick disclosures. The following presentation is for educational purposes only. All symbols and trading ideas discussed by the instructors are for demonstrational purposes only and are not recommendations. This presentation is not an offer or solicitation of any kind in any jurisdiction where any TradeStation affiliate is not authorized to do business, including but not limited to Hong Kong and Japan. Active trading is not suitable for everyone. Options trading, options and futures trading carries a high degree of risk and is not suitable for all traders. Please read the disclosure information or the electronic disclosure available on the TradeStation website. Oops, that's the disclosure right there. All right, so it's great to be with everyone. Now, as you guys may know, I am the VP of Market Intelligence at TradeStation Group. I do a lot of work with our Market Insights blog. And before we get started, I want to just mention some of the things I've been working on because a lot of these webinars I do in many ways are good to do in conjunction with the with reading Market Insights and some of the other information that we provide. So I wanted to show you over on TradeStation. If you go to tradestation.com, you can see my screen here. If you go to TradeStation, you go to Insights, and here we have Market Insights. This is a blog I work on. And just today I did an article I thought was kind of interesting about some interesting technical patterns that are popping up in technology stocks like, NEO and Roku and advanced micro devices. Some of the smaller names and interesting things are starting to happen on those charts. And it's something I'm probably going to talk about in the next masterclass. And I wanted to just kind of share this with you because to me, it in many ways shows that this question of weak market breadth that we've seen recently, in many ways, might actually be starting to have a solution. We might actually start to see this ending. But right now, we've had a period of weakening market breadth, and as we're going to talk about in the webinar, some of the ways that you're able to kind of look at that. But I did want to mention, I'm going to jump over now quickly to TradeStation just to show you this workspace that I actually was just making today. It basically shows look at a stock here like NEO. This is the one I wrote about today on Market Insights. Look at how the 50-day moving average is coming up to the 100-day moving average. This pattern is popping up all over the technology space right now. Smaller tech stocks, like here's AMD, has it. I've created a special indicator for students in the masterclass, and that has some special tools that allow you to find, and this is what the tool is right here. It actually can go back and count and look at a stock like, for example, right here, advanced micro devices. It gives a number 9, which means that in this case, the 50-day moving average crossed above the 100 9 sessions ago. So this allows us to find companies that recently had moving average crosses. You can customize this study for simple moving averages, exponential. You can compare simple and exponential against each other. It's really versatile, and it's one of the things that I've been creating for people in masterclass and showing them how to use. And it's one of those things that if you're interested, I want to go to You Can Trade and check out masterclass because it's one of those things that we often do. So this is a workspace I'm working on. I'll have more on it in the future, but this is the main workspace now that we want to be working on. This is the market breadth workspace. Now, I want to thank Nico. He's been sharing some links, I believe. Let me make sure we have the zip file. Wait, is this? I think that's the wrong link, Nico, for the zip file. Let me just get that. Sorry, folks. So this is a zip file, which has a series of tools in it, and it includes. Here we go. Get it. There we go. Okay. This zip file I just shared, it's a You Can Trade, uploads, and then a zip. If you open the zip file, this is what you're going to see. You're going to see 2 PDFs. This is PDFs I have. For some reason, my PDFs look like Chrome documents. One of the PDFs is the Art of TradeStation breadth. These are actually the slides for today's webinar. If you want to have them, they're in there. And then this is another file I'm going to be referencing, the calculated indexes. But the first thing you want to do is this Art of TS July 2021 breadth. This is an easy language document. You need to import some of the indicators that are in here. So if you double click on it, it's going to bring up this import wizard in your TradeStation. It's going to have a series of indicators. Now I already have them, so I'm not going to import them, but basically you need to import these. After you've imported them, you can double click on this blue, the trade market breadth art of TS. This is a TradeStation workspace. You can double click on that and you will see this. This is the actual workspace that we're working on now. Okay, so let me jump over now to the agenda. That's how you load it. First, I wanted to show you how to load the indicators in workspace. And now I want to go into looking at defining market breadth. Basically, market breadth analyzes the strength of the overall market by showing how stocks are performing together. Market breadth looks deeper than the simple price performance of the market cap weighting of major indexes like the S&P 500 and NASDAQ 100. Market breadth can help anticipate reversals and changes of direction in the market. So most of you probably know to a certain extent that certain companies like Apple or Microsoft dominate the S&P 500, the NASDAQ 100. These are market cap weighted indexes. So if you have a company that's $10 billion, it's in the S&P, and then you have, Apple around 2 trillion, Apple is going to account for more of the S&P 500 index, just logically. Now, this is obviously very important because if you're an investor putting, $1 million to work, if you're managing money, you're not going to put an equal amount of money in Apple and then some small company. So the index is intended to model portfolios on. So therefore, it's weighted to market cap. This makes a lot of sense, but it also has certain drawbacks. So these major indexes emphasize stocks like Apple, Microsoft, and Amazon based on their larger capitalizations. Well, this helps show how overall money in the overall money in the market. It can overlook strength or weakness in stocks overall. So consider this: Apple is bigger than the 47 smallest members of the NASDAQ 100 combined, and almost 1/4 of the S&P 500 combined. If you look at market cap. So that's just an interesting little, thing to think about. So if you go a little bit more and you include the other names, Apple, Microsoft, Amazon, Google, then you basically have 38% of the QQQ consist of those, 4 stocks. And then you throw in Facebook and Tesla, and you're looking at something here. These were just some numbers I came up with over the weekend when I did the math, but basically 1/5 of the SPY is those 4 companies. And then if you throw in Facebook and Tesla, you have 1/4 of the SPY, and almost half of the Qs consist of those companies, which are less than 1/20th, like 1/20th or something of the overall NASDAQ. So this shows how traditional indexes, despite their huge benefits, and no one's saying they're not good, but they overlook hundreds of companies, dozens of industries, and entire sectors. So think about this. You can have a sector like real estate investment trusts or energy or materials that barely even show up on the radar screen compared to some of these large technology stocks. And it's important just to at least have some awareness of those. So this is one of the overall drawbacks of using the market cap weighting. So one of the things we're going to show you is how to work around that. And there's a few different techniques. Now, as we look over here at the, let me just show. All right, so we actually just show on the workspace. Let's take a look now. We're going to look at something called RSP. Now, RSP is an ETF that gives roughly equal weighting to all 500 members of the S&P 500. And what's interesting about this is that you can see very clearly on this chart right here the performance of the S&P 500 against RSP. Now, I have this set up using an indicator called relative strength. And what this does is when this shows the performance of S&P against RSP. So basically, when the S&P underperforms, it means that small companies are outperforming. So as it says here, negative readings mean the breadth is actually stronger. So what this means is that when the S&P, the big S&P underperforms the equal weighted, you're actually seeing a time when more companies are going up, and the large companies are not carrying all the burden. So what's interesting here is if you look when the market came out of, we had the vaccine news and stuff late last year, you can see that we had a strong period of time here when the RSP basically outperformed the SPY, and SPY lagged, so that the large caps lagged, the mega caps lagged. And what's interesting here is you can also see the white line. You can see the white line, which is RSP, was advancing, advancing, advancing. But now look what happens when we get up here. We suddenly see something else happening. RSP, starting around May 7th, doesn't make any new highs, but the actual S&P cash index, or the SPY, continues to make new highs throughout June and into early July. This was a sign that breadth was weakening in the market. So right off the bat, we can see the way that this appeared. Now this is one very simple tool. I'm going to show you. The main tool that people use is the advanced decline line, and that's what we have here. Let me go my slide for that. The advanced decline line compares the total number of advancing stocks to the total number of declining stocks as a running net total. The value itself that you're going to see on the chart is insignificant because it varies based on whenever the data begins. We observe only its trend relative to the broader index's price action at the same moment in time. So basically, when the advanced decline line is falling and the market is going up, that is potentially bearish. And when it's rising along with the market, that is potentially bullish and giving a confirmation of the overall strength in the market. The advanced decline line requires a series of certain data parts that have to be put in. And sometimes when people build it on TradeStation at first, they get a little bit confused about that. So I want to take a second to actually explain, how this works. The main thing you're going to have is a chart with the key index. And right now we are on slide, if you want to look at yourself, we're looking at slide right now, slide number 8. So I'm going to go over my workspace and I'm going to show you these things. You need to have a main chart with the dominant index. Now with TradeStation, we have multiple data. So if you go here to edit symbol, you can see that this chart contains 3 different data or symbols. One is the SPY, but then it also has this special index called advancing declining issues. And this is for the New York Stock Exchange, and the advancing issues and the declining issues. So it has 3 different symbols on the chart. The main symbol is here, and then it has the other 2 symbols, the advancing and declining symbols, that their actual data is down here in this kind of gobbledygook. This is irrelevant, but it has to be on the chart because it's going to be used by the blue line, and the blue line is our advanced decline line that we actually want to look at. So basically, here we can actually see these are the key parts. Your key data, and then you have your multi-chart data, your multi-data chart with the advancing and declining symbols down here, and then you have this indicator. So if you actually click on this, you can see that this is an indicator, and it accepts as inputs data. It accepts as inputs these other data points, which for some reason I was messing around with this. You know what I did? I was adding symbols and removing them. It's calling this data 6 and 7, which in some ways doesn't make any sense. There used to be a data 2, 3, and 4. I was editing it, and it kept those tags on it. So, but the key thing is that you see you have data 6, data 7. These are the symbols. These are the data points going in. And then the second thing you have is you have an indicator, which you go to study, add study. You can add, there's something here called advanced decline line. If you look, that's under studies. I already have it on there. So if I now go to edit studies, if I go to studies, edit studies, you can see I have basically advanced decline. I also have the moving averages up here, the price moving averages, which I'm going to use in on another chart. So you can see it's important just to realize that the advanced decline line on TradeStation is an indicator that requires 2 data inputs. Okay, there are other things, like for example, when we go back to this first chart, relative strength uses one main data. If you look at this chart has, it only has the, it has the SPY data and it has the RSP, but relative strength, it accepts the symbol that you're going to compare as an input on the indicator. So just so you realize, these indicators work differently. Advanced decline line sometimes confuses a few people because they don't know that you need to have the advanced decline line indicator and then two separate data series coming in. And then you have to make sure when you're doing the advanced decline that you have the correct, here in the input, that you're doing the correct data series. So just realize that. Now, all these indicators I'm sharing with you guys, or these workspaces, I would recommend that you save this and don't mess around with it at all. Or then you can save a copy of it if you want to make changes, because some of these, they took me, a while to kind of build, and this is easy to kind of make some mistakes and get confused. It's really great functionality, and you can do some really amazing stuff with this. But I have these set up to all kinds of different axes and stuff. So I have this data on the left axis. I have this blue line on the right axis. It makes it really easy and great to view. Okay, so just so you realize the way this actually works. So I want to just mention, and that's the workspace I just gave you. This can allow you to keep dedicated charts to the S&P 500, NASDAQ 100, and Russell 2000, which you've just been given on these charts. If you look in the workspace, there's a bunch of other charts that I'm going to get to. So let's just look at some history, because the advanced decline line has often given signals of when the market is stalling. When you see the market hitting a new high and the advanced decline line falling, this is a form of bearish divergence that tells us that the overall advance is losing strength and it's not supported by the internals of the market. So let's look at some historical examples. Now, I want to just point out, this is SPY that uses the advanced decliners of the New York Stock Exchange. So I did this because the data for the advanced decliners of the S&P 500 don't go back as far historically. So right here, this one is the SPY compared to the advanced decliners of the S&P 500 index itself. This one, and this has some other stuff on it I'm going to get to, some other really cool studies. So I wanted to show you now historically. Now we're looking at the New York Stock Exchange advanced decliners and the SPY. So let's look now at some different points in history. Let's look at the last time this really was kind of relevant was in the summer of 2000, late summer 2018. So now I'm looking back, this line right here, and this is on your chart. If you look here, remember in early 2018, we had this, the market got incredibly ahead of itself. It crashed, we had this chopping, and then it melted back up to the old highs. Now we're here, look here in like August through September of 2018. You can notice right here, if we draw a line, you go to drawing and then a trend line, you can see that the advanced decline line was actually falling, and the market was making new highs, and then it just fell apart. So that's the most recent example. Then we can also look back to June, and this is one of my favorite sell-offs. This is when I started trading futures, and this is one that I was looking at, and I was fortunate to capitalize on. I was looking at similar sort of things here. I have to just adjust this to move this up. Let's look back at the summer of 2015. The market was basically stalling, moving sideways, but you can see here the advanced decline line had been falling all throughout 2015 to summer, and it was really clear around the period of June through August. And then we have this crash. The advanced decline line, though, in this case, the market was kind of just moving sideways, maybe slightly down, but you could really see the internals kind of breaking apart at that point in time. That was in the summer 2015. Go back to October 2007, before the great sell-off of the financial crisis began. And if we look at here, October of 2007, where this line was, you'll notice the market making new highs. And wait a second, let me find my advanced decline line. There it is. See, it kind of moves down as I go back in time, because remember, this is set back to the beginning of the actual advanced decline line. And you can see right here, look at, for example, in June of 2007 versus October of 2007. the advanced decline line was going lower, and the market actually made a new all-time high. That was a very, clear bearish signal in a way at that moment in time. And then if we also look back, there's one period of time I remember in the spring of 2006, we had the same thing. We basically had in June of 2006, the market basically pulled back and the advanced decline line was also falling. At this time, it was inching lower as the market made new highs. And then finally, perhaps the most dramatic example of this was if you look back in at the end of the rally of the 1990s, the great bull market of that time. What you can actually see is going through the year kind of throughout between really 1998 all the way through 2000, you had the advanced decline line really weakening here and the market hitting new highs. So this is probably the most massive example of the advanced decline line giving a signal before the market crash. So this has historical precedence. It's one of those things that is not always going to be massively useful, but it's something that we do need to be watching and looking at from time to time to just have a sense of what kind of health we're looking at in the market. Okay, so advanced decline line is one tool, but it's not the only tool. Now let's look to this next chart. If you look along, and now what we're looking at is we're looking at something that has even more information on it for us. Now this is the SPY. Now just so you know, this chart we're looking at right here, this is SPY, this is QQQ, and this is IWM, the Russell. These are basically the same chart for the three different indexes. So right now, let's just look at the SPY. So moving average indexes can provide another view inside of the major benchmarks like the S&P. TradeStation's pre-calculated indexes can display the number of stocks above key moving averages. Falling values can show weakening breadth. Comparing stocks above their faster 20-day moving average versus slower 50-day moving average can provide crossover signals. And I want to just point out, this gave some very interesting signals on QQQ in both March of 2020, March and May of this year. I'm just going to show this to you really quickly so you can see. Look at Qs here. I put some arrows, this blue arrow and this blue arrow. You'll notice how this started rising even as the index itself was consolidating. And this shows that more companies inside of the NASDAQ were moving above their 20 and 50-day moving average. And then we saw that here as well. So you had this big breakout and rally in the NASDAQ in the last 2 months, and then this was flagging it. I'd also mention that this is something that we were writing about at many points in time on Market Insights and when we were talking to Sarah Potter and stuff on You Can Trade. So these were things that we were covering at the time and things that were covered in Masterclass. And so I want to just point out that this was stuff that at the time we saw this happening in different ways. And I think the main thing was you did start to see the improved relative strength in some of these. Anyway, let's just go back to SPY to explain this to you. So now this is a complicated chart, but it's got a lot of interesting information in it. First, it has the S&P 500 itself. And just so you know, I use blue for the 20-day. I use red for the 50-day. If you ever are curious or confused, you can hover your mouse and click. And what you'll notice is you can see in the little dialog box that comes up, it says fast average and slow average. You can see this thing that comes up at the bottom of the dialog box. I can't move my mouse when I do this, but you can see. And that basically says what the average is. And then if you're curious what those averages are, if you actually click on it, and then the box comes up, you can look at the inputs and you can see 20 and 50 are the inputs. So this allows us to see the S&P itself with its 20-day and 50-day moving average. I use the same colors down here for these. These are custom indexes built into TradeStation, and these were brought in as data. So if you look at data, this has a whole bunch of symbols in it. This has the SPY itself, and then it also has a custom index that we calculate, our system calculates and shares with users, showing the number of companies above their 20-day or their 50-day moving average. It also shows companies hitting new highs and lows, and then you have the advanced decline line. A ton of information here. And so right here, by looking at this, what we can see is, and this interestingly matches the underperformance that we see right here in RSP, and we start to see the market, kind of peak, kind of slowing here as the mega caps take over, the large caps and the small companies fail, what you can see here is you can see the same thing. Fewer companies were above the 50-day moving average, even as the market hit new highs. Fewer companies were above the 20-day moving average. So you have that exact same sort of scenario. Now, this next study basically has two data points. It has the companies hitting new 52-week highs and companies hitting new 52-week lows. This is normally useful, but you guys might have noticed that because of the sell-off last year, it caused a lot of data anomalies. You have this incredible spike of companies on like May 10th that hit new 52-week highs, and that was simply because that was kind of the point in time when a bunch of the old bad data from March and April of 2020, those lows were just too crazy, and they got just pushed off the data, and then suddenly every chart on a trailing 12-month basis was up. So you had this distortion. When we get back into more normal market scenarios, this can be useful. And then you want to use it the same way. If the market's hitting new highs and the companies hitting new highs are going down and the company hitting new lows are going up, that's going to tell you something. Now, this is also good to the downside. Say the market is crashing, and then you look back and you see how many companies are hitting new 52-week lows. Say the market's been bottoming for a few months. What you're going to start to see before the move goes higher, you're often going to see the number of this line will go spiking up. If we drag this back in time, you can see companies hitting new 52-week lows, it's spiked. And then what happens is you're going to start to see this number falling before the market turns. And so I color coded it so it's obvious. The companies hitting those levels are bearish. So this just allows you also to see the concept of breadth works to the downside as well. So I'm not always sure if advanced decline line works to the downside when the market is bottoming. I use that to spot tops. However, these tools can be used a lot, and that's why I said you should keep them over time. So just realize right here we have the number of companies in the index above and below, or above the 50 and 20-day moving average. Here we have companies hitting new highs and lows, and here we have the advanced decline line. Let me just show you. Just look at this. You can see here that this data here, these squiggly lines, are on the left axis. See, so if I adjust the left axis, the blue stays the same because the blue is on the right axis. This is a little trick I wanted to show you. Sometimes if you want to show totally different data on a chart, what you can do is you can put them on different axes. And that way you can compare a $2 stock to a $100 stock without having a crazy axis problem and without having to multiply one or doing something crazy like that. And just so you know, if you ever want to do that, if you double click on a data or any chart, you're going to notice if you go to scaling, you can control what axis it's in, and then you can control what subchart it's on. So if you look, the advancing declining issues, like I said, it's on the left axis, it's on subchart 4. So you have 1, 2, 3, 4, and then you have left axis for this. And then if I look at the advanced decline line, you can see this is on the right axis. So that's just some techniques you guys can use to kind of when you organize your own charts. It's also interesting if you look back historically, that kind of crash that we had, if you look back in 2018, like I mentioned in October of 2018 here, you'll also notice that we had the same thing with the moving averages. We're basically, you can actually see this if you look at this. The moving averages were the number of companies above the 20 and 50 were falling as the market hit new highs. And then also it's interesting here, as the market bottomed, you can also see that fewer companies are hitting new 52-week lows. And you can also see here that the advanced decline line, if we bring it back on this chart, like I said, the advanced decline line was already signaling this with this weakness over here. So anyway, again, this part of the moving averages did actually flag this. And it was also preceded by fewer companies, here we go, making new 52-week highs. So if you look here, as the market moved higher, the number of companies making new 52-week highs, this green line here, was actually trending downward. So right here, the day before the crash, only 28 companies made new 52-week highs, while back here you had companies like over 60 companies in the index making new 52-week highs. So these are other forms of measuring breadth in the market. Now I'm going to move on to slide 11. Showing some more stuff about how to, just wanted to explain a little bit more of using these equal weighted ETFs. So with equal weighted ETFs, we have the Invesco S&P 500 equal weight, and we have the First Trust NASDAQ equal weight QQEW. And you can use these in TradeStation. I use them on 2 different tools on TradeStation that I've included as examples in this presentation. If we go down here, this is radar screen. Now, as I mentioned, this. All right, I'm sorry. So this uses right here, this compares to RSP. If I wanted to change that, for example, let me just show you very quickly what I can do. I can go to copy. I'm going to just open up to keep myself from getting too crowded. I just created a new workspace. I hit that plus. I'm going to go to paste window. Now I'm going to show you how you can adjust this to work with the NASDAQ. The first thing is you want to change SPY to QQQ. And then what you want to do is you go down here to relative strength, and then you want to change the input to QQEW. QQEW is the equal weight version of the NASDAQ 100. And then also we want to change this, because this is RSP. We want to change this to QQEW. And now let's let this reload. And now we're going to see a similar sort of thing. What I find very interesting here is that one of the things that blew my mind about last year was stocks like NEO and stocks like Carvana. And these are some of the ones that I wrote about in this article today. If you look at this, some of the moves, Zoom Video, some of the moves these companies made last year were incredible. CrowdStrike, companies like Stitch Fix, Upwork, Roku. All right, huge moves. The NASDAQ was rallying, and the small NASDAQ stocks, some of them really outperformed in a huge way. And that was a big thing I wanted to mention in this, in this today, when I looked at some of these companies with those moving averages. And what's interesting is as the market, look right here, when we get to September, we actually start to see here that the big mega cap NASDAQ stocks here kind of stalled. This is when Tesla and Apple split their shares, and then they kind of moved sideways. And then you see here that the QQEW outperformed. We had an incredible period of time that really lasted until mid-February, when these small companies were just flying higher. Stocks like NEO, stocks like another one that I looked at a lot was a stock like Fiverr, FVRR, which is, I can just show you this really quickly. I mean, they did this outsourcing stuff. I mean, some of the moves in some of these companies were incredible. Anyway, these smaller, kind of under $100 billion growth stocks had that incredible period of outperformance. And then we had the reopening trade. Oil and gas started rallying. Financial started rallying. We had the shift of value stocks. And the entire, small tech stocks, small growth stocks just stopped, and they all died and just drifted. And that's what my article today is about, is that it's possible that some of the technicals suggest that those names, do have some potential to work going forward, because we're starting to see their 50-day moving averages are rising. They're above the 50-day moving averages. The 50-day moving average is rising above the 100, and in some cases above the 200-day moving average. If you look at a lot of these stocks, so I think it's very interesting to see. You can see these blue spots here show when the QQQs outperform, and those smaller names just totally lagged, and they suffered and they did nothing. Let me go back to this other workspace that I had shown. And I think this is important to look at, because if we are going back to that period where we're seeing the smaller names outperform, then there could be a lot of interesting opportunities in some of these smaller companies. I mean, a stock like NEO is an interesting company, because you have a Chinese, auto, electric car stock that here it is. It basically hasn't gone anywhere now for almost, over half a year. It hasn't made a new high. I mean, it made new highs, but it's back where it was in November. And it's just now starting to see a signal like this. So one thing I really want to watch is how does the QQQ perform against the QQEW going forward? If we start to see this red increasing down here, it's going to mean that the smaller companies are outperforming. I want to apologize for the fact that it shows up as being red and bearish, but it's the way relative strength, the indicator works. But just so you realize, like in this case, the lower readings would show a positive breadth in the overall market. So anyway, I wanted to just kind of to highlight this because as I look at some of the things happening in the chart and literally some of these scans that I was just pulling up in the last day or two before I even scheduled this webinar, I'm starting to see that the weakness in breadth that we saw that caused the crash in the last week and a half could actually be starting to abate. And I think that's actually something we want to watch going forward. It could be very interesting. We're at a point right now in the economy where there are companies out there that are solar energy in particular, I think we want to be aware of. Look at the TAN, Solar Energy ETF. This was the top ETF, industry ETF, all of last year. It had this incredible surge, pulled back really hard, and now here we are. The 50-day moving average is about to rise up to the 200-day moving average. Look at a stock like XPEV, Chinese. And this thing is really interesting. You have electric autonomous vehicles, LI, basically self-driving electric SUVs in China. Brand new companies that only went public last year. Very interesting. We're seeing these patterns on them. Look at First Solar. All of these stocks had huge rallies last year and have been basically spent 6 to 8 months in the penalty box. And now there's maybe not quite that long, 5 to 6 months of consolidation. And now we're starting to get signals on them. So I think it's important to realize that the weakening breadth that we saw over here on this big chart of the S&P, this weakening breadth we saw should be understood in the context of this period of time here. You can also look at this other, let's look at QQEW. Now, this doesn't really, you don't really see by looking at this necessarily how weak it is, but look at QQQJ. This is a smaller version of the NASDAQ 100, and we see this has not made a new high. These are basically the NASDAQ 101 to 200, the next set below the 100 in terms of market cap. It has Roku, it has Enphase Energy, which is the solar stock that last year was one of the top performers in the S&P 500. It has stocks like CrowdStrike. It has stocks like Zscaler, which went up a lot last year. It's a cybersecurity company. Those are in the QQQJ. And this is basically not, this is not broken out yet. So what I'm watching here and starting to pay attention to is that this could actually, if we see this moving, then what you're going to potentially see is that's going to impact the advanced decline line and the breadth in the overall S&P 500. So this is something I think we want to watch in the next month or two. Another stock I just have to mention that's been on my radar is ALB. This company is, they do cars. I think they actually do batteries for Tesla and other electric vehicles. This is one I've been watching recently, and this price action, look at how the 50 crosses over the 100 here, and then we start getting this bullish price action. Very interesting to see this. This is also, not a huge company compared to Tesla, not as well known. Technically, I think it's a chemical stock, but it's an electric vehicle, electric battery kind of stock. Okay. So anyway, that was just a quick little thing I wanted to mention because I always want to think about how do we apply this to the kind of stocks we select. And, like I said, I'm starting to look toward those mid-cap tech stocks in the next few months to see what happens there. I also would mention with the decline in interest rates we've seen recently, the shift away from value, this is a sort of environment that does favor these growth stocks. I think we have this whole idea of the Delta variant of coronavirus coming back. I'm not sure how impactful that will really be because it has a lower lethality. At the same time, the economic data has not been amazingly great for the last 2 months. The housing data has weakened a lot. Some of the industrial numbers have been poor. We have seen, weakening. We have not seen amazingly great job growth. So as these the slowness happens in the relative slowness in the economy and falling interest rates, that also favors your smaller technology stocks and your growth stocks. Now, we've done webinars all about that. If you look on Market Insights, let me just quickly go back and show you. If you go to Market Insights and you go to Education Platform, there's a series of my previous webinars here. And we go through and we explain how to do fundamental analysis on TradeStation, how to understand stocks and sectors based on things like PE ratio, earnings yield, price to sales, and how the macro environment of interest rates actually impacts that. So just so you know, that's things we've covered in the past, and a lot of those resources are available for you here. Finally, I want to go back to the workspace right here, market breadth. I want to point out, now this is radar screen. Just so you realize that the studies we've used for this are if you go to apps, you can see chart analysis. Where's my chart? I've moved these all around. Here's my chart, and here's radar screen. I use radar screen all the time. It is incredibly powerful, and if you guys haven't used it much, I cannot encourage you strongly enough to study it. Email me about it if you want to learn more about it. Check out Masterclass, because a lot of the functionality in TradeStation and a lot of the analysis I do comes from that. Anyway, let's look here at this radar screen. This includes a series of columns. Now, these are custom studies I've created. I have my own nomenclature. I like to call a week, I call it 5D. It just kind of keeps my head straight, because sometimes on some platforms, 1 week, if you look at it on Wednesday, it will show a week to date. There's certain data schemes that do that. So I just create something that these are indicators that look at 21D is a month, because there's roughly 21 trading sessions in a month. 63-day D is 3 months, 6 months, 1 year. So let's look here at the 1 year performance. If you click on this, you can see I have the SPY and RSP, and then I have the QQEW and the QQQ. Look at the 1 year performance. The 1 year performance shows RSP outperforming, SPY. But then if you look in the last month, you can see SPY is up 3.3% and RSP is only up 1.2%. That is what you see right here. That's the exact same data showed differently. The nice thing about this is you can look at it over different time frames. And it's interesting to look, if you look in the last week, we're actually starting to see that RSP and QQEW are outperforming the market cap weighted indexes. That's what I'm talking about. And that's why we want to see if this continues, because if it does, it would actually show a change of the sort of companies that outperform. If you just look at this radar screen every day, this is basically a grid version of the same data we're putting up on the charts. I also have this thing called in range multiple days. This is a custom indicator I've created for the for Masterclass and some other classes I've taught, that basically looks at over a 21-day period. Where is the SPY in its overall range? The lowest value is minus 100. The highest value is 100%. And so basically, it's just the bigger the number means you're closer to the top of your range. And again, it's interesting, if you look in the last month, not surprisingly, SPY and the QQ SPY is higher in its range. And this is one that can just kind of help you see over different performance. At this moment, this is not giving any kind of clear signal, but this is also something that allows you to compare, what's doing better over a certain time frame. And it's just useful. All these things to me they're useful at different times. Is not one I always look at. That's why I like to see, price performance, your in range, your year-to-date performance, and then this other indicator is distance from 52-week high. What's interesting about this is you can see QQEW actually made a new 52-week high today. Let's go over here and look at this. It basically closed. It was basically closing pretty much on top. This has a rounding, so it rounded it to 0, but it basically closed at its high. And then look at QQQ. It's, decently off its 52-week high. So this is exactly the sort of thing I'm talking about. I hadn't even noticed that until just now. So these are some of the things we can look at. All right. So like I said, these are all some of the different things that we talk about in our master class. Jesus Nava is the main instructor on it. I do, once every week or two, bringing in some of these, analytical tools, and it has a lot of interesting things of, showing you how to do strategies. There's stuff we haven't even gotten into with strategies when you can automate things on TradeStation so that it will apply different indicators, which of course you can customize. And then when certain things happen, it can actually trade in your account. And that's some of the stuff Jesus teaches a lot of. There's a lot of classes and online, resources available, and question and answer and stuff. So anyway, I want to just mention the master class is available, and it's on You Can Trade if you want to check it out. If you guys want to sign up, this is actually the link to it. Let me actually get this link. And where's the link? You know what? Here we go. It's over here. Let me get this link. Okay, great. Let me look, see if I have any questions now. What indicators would be more relevant for futures, such as E-minis, I think you mean? Really, it's all the same in many ways. The one thing I'd say about E-minis is that you can get confused by data sometimes, because depending if you're looking at hourly chart or something, it's going to include, out of hours, things like that. I would say overall that, the way I would view this as someone trading S&P E-minis is when you see this kind of divergence like this and this I would just look at this as being, contrary indicators, non-confirmation. So basically, if you actually look, I should actually mention one other thing. I do some things as outside on. This is TradingView. This is an outside charting service, and we publish ideas on here. It's something you can link to TradeStation. And a lot of cool functionality you cannot do necessarily as much as you can with our platform, but it's an outside thing, charting service that allows you to link your account. And I publish a lot of trade ideas on here. And so here today, I actually wrote about XPEV, and I actually did this article here about breadth. But this is one that really I wanted to mention was the small caps. We had done a bearish note on this one, back here, and then you can see that it dropped. Now it's actually back to positive, but it had a nice follow through the downside after we published it. And we put some of these ideas up here. So I wanted to just mention that those go up if you want to actually see on TradingView some of these ideas and some of these things as they pop up. We will often publish there. And then I also, as mentioned, I had done multiple times. I've been looking at some of the interesting sort of price action and energy. So a lot of these are the different things that I do. Now, your question was about the S&P, and what I'm saying, here's my point on this: is it basically, if you look at, I didn't do it in this chart, but my point is that I was starting to see the bearish forces developing. In fact, most of the stuff I've talked about with breadth today was in our masterclass last week, and we saw these bearish forces developing. So basically, when you're looking for reversals and you're looking for opportunities to get short, this gave a relatively, clear or relatively strong signal last week that the market was tired. So the main thing I would say is if you want to chart SPY, I would use SPY. The other thing is if you have the E-minis, sometimes the E-minis, the thing is that the data might be updated on different time periods. So if one of the data is delayed or it has a different time zone or something like that, and this happens occasionally when you use multiple types of data on TradeStation, I would recommend you just use SPY, and you can use that, and it will always work with your advanced decline line, your new highs and lows, and your stocks above the 20 and 50. All those things will work that way. So I would just chart the SPY and then use that. And then when you're starting to actually trade the E-minis, trade the E-minis, but do this level of analysis with the SPY. Actually, the one other thing that I did not mention is if you go to here out of TradeStation, the actual zip file, if you click on this TradeStation calculated indexes, this is a list with thousands of pre-calculated indexes. Things like stocks above their 52, hitting 52-week highs and lows, advanced decline line, volume of market advances, and all those sort of things are in here. If you want to dig in, these are all provided here. So that was the last thing I wanted to share. That's in the zip file for you. Let's see if I have more questions I'm missing. What do I think about TRIN? This is an indicator that I have not really used. So I don't have any real thoughts on it. Can we incorporate this with the percent runners in rapidly rising and hot lists? The market open for momentum symbols? Not really. Market breadth is, these are daily signals over longer term sort of conditions. And when you're looking at some of those names, those are very nuanced individual stocks with their own individual reasons for moving. The main thing I would say is that most of those are not really relevant to the index overall. But what I would say is that when the market is in a period of relative calm, those names make more sense to trade. One of the basic things that I've kind of taught is that you'll notice the market goes through different periods of time. And when the market is more volatile, when it's crashing or when it's rebounding from a crash, it makes more sense to just play the indexes. Individual stocks will not behave as you think they will, but the indexes will. Then, like, here's the thing: we had this big bounce yesterday and today. So now the question is, tomorrow the market might be up like 0.2%, but individual stocks are going to start moving again. So from my view, what I would say is when you look at the overall index, think about that. Are we in a volatile correlated market? Then you want to trade SPY, S&P, Qs. Or are we in a low volatile stock picker market? And then some of those hot list things could make more sense. The best tools for understanding rotation. So I've done another series of webinars about keeping up with the market, bullish or bearish, growth or value. This explains how to keep up with any market. Different things about finding leadership in the market. If you look through some of the different webinars I've done here about finding leadership in any market, and I do get into that. I provide different tools that allow you to assess. I'm just looking back of some of the old webinars I did, but if you look through here, if you go to Market Insights, you go to TradeStation, then you go to Market, then you go to Insights, and then if you go to Education and Platform, and you look in here, there's a huge number of things. Some of these webinars, what I've done is I've created workspaces for people that allow you to see which sectors are outperforming. It allows you to then see, are we looking at a market where the big caps are leading or the smaller companies are outperforming? I've created radar screens that really allow you to break all that stuff down, including things like commodities and global stocks. Okay, is there an indicator for radar screen that shows market cap? Of course, there is. Excuse me. 1 second, folks. Now, a lot of these things don't have market cap because these are like special symbols and things. But over here, let me just kind of show you. I have this workspace I'm working on here. It only has one indicator in it. It has my special indicator, which shows the number, how recently this cross occurred. I can now go to studies, add study, and then if you start typing market cap, it's here. So right there is your answer. How do these charts work with gold or oil? The answer is they don't. This is about the indexes in the S&P 500. That is the main thing. The main thing I wanted to point out with this is that there's many ways to measure market breadth. And honestly, I seldom use the advanced decline line because this comparison with RSP basically gives a very similar sort of reading most of the time. The advanced decline line is the kind of gold standard way of doing it, and this is kind of the poor man's way of doing it. It's a quicker way that mostly works. It's not always as reliable over different time frames. The RSP hasn't existed for as long as the data on the advanced decline line. But what I would say is that this is something you want to kind of do to figure out, what do we feel about the market overall right now? Is it overextended? This is something that I would say that individual investors should look at every week or two. Save this workspace, bring it up every week or two, look at it for 5 or 10 minutes, see if there's any warning signs in terms of this falling, or if the market was crashing, and are we starting to see these things bottoming out? Are we starting to see fewer new 52-week lows, for example, at the bottom? And that can help you kind of make these decisions. This is really the main thing we want to use this for. Breadth is a good wide-ranging tool. but it's mostly focused on the indexes. How do you get a recording of this session? It will be on YouTube, on the TradeStation YouTube channel in the next day or two. I'm just looking to see if I missed any of the questions. Masterclasses, there's a question. Masterclass is one of the courses. It's under the basically on the You Can Trade website. And we have some links to it provided here. Breadth indicators for crypto. That is something that is a great question. And I don't actually know the answer to that. There's probably some interesting ways of thinking about that that I'd have to learn more on. You're looking at divergence. The answer is essentially yes, we're looking for cases of divergence. What is the advanced decline line doing right now? Well, it was falling and now it's bouncing along with the overall market. So that's the question now. If the market goes to new highs, does this go to new highs? Okay, looks like I got all the questions. And there might have been a question of the relative strength. Just so you know, I set this here to 10 sessions, which is basically going to be 2 weeks. You can change it to whatever you want. It's something of an arbitrary number, but just so you realize you can adjust these things. And the other thing is, if you use the relative strength indicator on the TradeStation chart, when you first create it, I'll just finish by showing this to you. Let's add relative strength here. Go to studies, add relative strength. I want to just show this. It will come up as a line when you first do it, right? So you need to go back and then edit it and go to style, histogram. I like to make it thicker. And then you get a histogram. I like it better as a histogram than a line. All right, well, that's the main thing, folks. Don't forget to check out Market Insights on the TradeStation website, and also to check out some of the things we do at TradingView. And we hope to see you in Masterclass. I'll be back doing it. I believe next week I'm going to be back in Masterclass. I do it every other Wednesday. Sometimes I do it every week. But great to talk to everyone, and the recording will be up soon. Thank you so much, and I'll see you again next month when I'm going to be talking about doing fundamental analysis on the TradeStation platform.